We're talking about the most important monetary policy event all summer. But first, let's revisit price volatility for the week. Talking with me today is Gary Wagner, editor of thegoldforecast.com. Gary, you're a trader. You must be loving what you're seeing in the price action today.
We are absolutely have had a couple of very exciting weeks. There's no doubt about it. Last week especially, we saw a pretty dramatic decline. We could see that continue next week.
So here's my first question to you for the day. If an investor were to buy gold because someone told him, hey, gold is a safe haven asset, and he's looking at the price volatility we've seen in the past 2 weeks. 2 weeks ago, we were talking and we saw the biggest single day decline since 2013. And he's probably thinking, gee, if I wanted a lot of volatility, I'd buy Tesla shares, not gold. I mean, is gold behaving like a safe haven asset right now?
In a lot of ways it is. You speak about the increased volatility, and there's no question we've seen some dynamic ranges in the market. Nonetheless, if you take the short-term noise out of the market and look at it over a long period of time, it is absolutely a safe haven asset. Considering that we are at new record highs recently, we've come down a little bit. The key is that as the Fed has been printing money and central banks are on a concerted effort to flood liquidity into the market, it has devalued the currencies. So even though there's an increase in volatility, the increase in volatility has a bent, and that bend is to the upside.
So you don't think this volatility is eroding investors' confidence in gold as a store of value at all, do you?
I don't, not a professional trader, and not those who have watched gold for years. I think that what we're seeing is a new level in gold, and that level reflects a new weakness in the U.S. dollar.
What do you make? Yeah, let's talk about the U.S. dollar. What do you make of the strength of the U.S. dollar in the last week and a half? What's happening here?
Well, we saw it decline mid-March. It was at about 103. It traded and tracked down to about 92, and then it had a bounce up. I'm not looking at this as a dead cat bounce, but I think it's a temporary bounce, and I truly believe that longer term, the dollar will return to its downward trend.
Why is that? Why would it return to its downward trend? Is there more monetary policy initiatives that you're looking forward to?
Well, really, it's almost the same monetary policies that we've been witnessing. We are in unprecedented times, and the things that central banks have had to do to just try to stabilize the economy have been unheard of. I've never heard the word quantitative easing and unlimited used in the same sentence. Although we're only buying $120 billion per month, the balance sheet of the Fed has swelled about $3 trillion, and it was sitting at 3.7 trillion. So we're at 6.7 trillion in terms of the debt on the balance asset sheet. That's the largest in history. We had the greatest contraction of GDP ever in history, 32%. We've got the greatest unemployment rate since the Great Depression. When you put all of those together, you have a central bank that really has to act aggressively, keep rates near zero, keep them there for a very long time, because we don't know an end game or when the pandemic will actually subside. And for that reason, I think we will see continued pressure on the U.S. dollar. At the same time, we're going to see pressure on all of the other core currencies because the other central banks are doing what we're doing. It's almost a race to zero.
Right. So if you compare the U.S. dollar to foreign currencies, which arena would you see more pressure in?
I think we're seeing it in the dollar. We've got a massive aid package that the Treasury Department allocated $3 trillion. We've already spent more money than we have in history to try to dig ourselves out of this terrible, terrible economic scenario that was caused by a disease. And I think that will continue.
Yeah, looking back at gold now, Gary, this decline that we've seen in the last few days, is this the start of a short-term bear trend?
It is certainly a correction. It is certainly a dip in the price. I view it as a healthy dip. When a market goes up as quick as we have seen it go up, and what was it, 450 middle of March 2000, that's a $650 move. And that happened in legs of the rally. Typically, a rally will last $100 to $150. A good rally, maybe $200 plus dollars. We saw the market move $600 in a 4-month period of time. So for it to back off by $200 to me is small change. I don't look at this as a major correction, and B, when we look at the charts, there's been no technical chart damage. We're well above the 50-day moving average. All of the other indicators that we are looking at tell us that there's more room to the upside in gold. Now, where will this correction end? That's the $64,000 question. We have certain numbers we're looking at, and of course, it's determined as events unfold. But all things being equal, I see the dollar headed lower and gold headed higher after the correction concludes.
So a lot of our guests on the show talk about when to buy and their long-term bullish forecasts, but what's equally important that our viewers are wondering is when to sell. And so I think last time we spoke, you were telling me how you sold your position above $2,000 an ounce. Tell us about some of the technical indicators you're looking for that would initiate a sell order in your mind. For example, right now, are you in a position to be selling, and what are you going to be looking for?
Okay, right now, our premium subscribers are neutral across the board in futures. We are looking for the proper point of entry. In gold, we could see it trade maybe as low as the 50-day moving average. That comes in at around 1960, but I don't really see a lot of, it's at 1939, so at about 1922. But I don't see a tremendous amount more in terms of the downside itself. What we look for is for the market to hit a particular Fibonacci retracement level. Then I look for a particular candlestick pattern that's a bullish reversal, and that's the trigger that we use to enter our trades. We are along the ETFs SLV and GLD, but those are long-term plays without leverage. I always believe that when you see a dip, if you're a physical buyer, accumulate more on the dips, because a half a year or a year from now, gold will be much higher. I can't tell you what the noise will bring in the next 2 weeks, but I can tell you in the next year, I truly believe we'll be looking at $2,200 or $2,300 an ounce gold.
So you don't think we're at the bottom yet? You think we're...
We certainly could be near the bottom, and a lot of it's going to have to do with what happens in Jackson Hole, which we'll talk about in a bit.
Sure. Okay, before we talk about Jackson Hole, one last point about gold. You brought up the word leverage. It's something we rarely talk about on the show, but I think it's important for traders to understand what it means to be levered. Would you ever trade gold on leverage? And if so, under what circumstances would you do so?
I've been a commodity trader and a trading advisor since the 80s. So the answer is yes. You have to be well capitalized. I believe in putting double the margin that is required. And for those that are unfamiliar with the term leverage and what that means, it just means you have increased buying power. So take, for example, you buy a property, a home that you're going to live in, and the home is worth $200,000. You put 10% down or $20,000. That's leverage because the bank is giving you the other $180,000. Now, if you sell that property 2 years later for $220,000, you've put in $20,000, you've made $20,000, you've in essence doubled your money on that because of leverage. However, remember, the reverse is true. If it moves against you, it can have the equal strong damage that it has when it works in your favor.
What about levered ETFs, like 2-3 times daily move ETFs? Would you consider those products?
Well, Nugget has 2X. I tend to like the ETFs without leverage. That's why I'm using those vehicles. If I want the buying power and the leverage, I'll go right into the futures markets. Some of our subscribers use Forex, but that's where you get the leverage, not the ETFs, because the ETFs have a lot to do with how they manage the purchase of leverage contracts, which is what they're using to gain that leverage.
Okay, let's talk about monetary policy now. Heading into Jackson Hole's symposium next week, what did you make of last week's Fed announcement?
The announcement itself, I thought, was on par with what I expected. It was the reaction that I felt was a typical knee-jerk reaction. And it's concern with how the Fed is going to move forward. And of course, this week we're going to have the first virtual symposium in the record in the history of that economic symposium. It's going to be held virtually. And what's going to be interesting is the topic itself is navigating ahead in the next decade and what are the monetary implications. So what that says to me is that when you've got all of the major central banks getting together, they recognize the need for a long-term plan rather than what's the economy going to look like next year. They're actually looking out in the next decade. What that tells me is that they know that the crisis we're in is not going to be resolved overnight. Mm-hmm. And so that's what's so critically important. I believe that it could have a detrimental effect on the U.S. dollar. If it does, we will see gold take off, and that will indicate the bottom of this recent correction.
How do you think they will address their dual mandate and how they would be implementing new, I guess, monetary policy philosophies going forward? Because as you know, the Fed has a dual mandate of keeping inflation under control and maximizing employment. So the target 2% inflation is not being met right now. Their target unemployment rate, of course, is nowhere near being met. On all counts, they failed with their monetary policy this year. What's next for them?
Well, they have absolutely failed. First of all, their target of 2%, they've been running shy of that for years. I think they will address that and maybe have a more realistic number than 2%, closer to what the target, make the target closer to what the actual numbers are. I don't foresee them changing the Fed funds rate. I expect them to keep it near zero for as long as they need to. And based upon that fact, that is going to increase the likelihood that the dollar will go down and that gold will go up.
Gary, how likely do you think that the United States will enter into a period similar to that of Japan in the 90s, where the central bank is accommodative in their policy, yet we're seeing very little inflation, very little economic growth, and generally just stagnating economic development? Could that happen?
Well, a stagnation and little economic growth would be a far better circumstance than we currently have, where we have the greatest contraction of GDP in history. So when you've got a market that is coming out of the most robust economic expansion in history, and that was the talk of last year's symposium, it's the exact opposite. This is kind of the worst case scenario. Mm-hmm. And because of that, the key with the Fed is to stabilize the economy first and then kick it into gear so it can begin to grow again. But it's kind of like a train moving down a track. Before it reverses and goes the other way, it has to stop. And so to me, stabilizing the economy and having slower growth or very little growth is so much better than having a tremendous contraction in the economy. So I would look forward to that because that's going to be the first step to rebuilding.
Goldman Sachs released a report over the weekend saying that a lot of the workers that were laid off are not likely to return to full-time employment. In fact, they'll be permanently unemployed until at least 2021. This is terrible news for not just the workers, but analysts as well, who have been anticipating the temporary workers to drive up the employment rate back to normal. So how is the Fed going to respond to this?
The Fed has used a lot of its tools in its toolbox. And I think that the answer to the question you are talking about is really going to be whether or not the Congress and House can come up with some sort of an aid package. Initially, we had, about 30 million unemployed. I believe we're down to about 20 million. That's still an enormous number. And there's going to have to be a concerted effort for retraining to get people that are unemployed into new high-tech jobs, because a lot of those jobs, simply put, are going to be phased out. Corporations learned how to really lean down their workforce when this pandemic first hit, out of necessity. And the ability to slow down the burn rate, so to speak. And a lot of those people are not going to come back. They've taken away middle layers of management. other types of positions. So retraining is essential. Aid by the government for those unemployed, for those who can't pay rent, that's essential. The Treasury Department is really going to be in unison with the House and the Senate, the entity we need to look at for those answers, because the Fed's not going to zero interest rates, and there's only so much money you can continue to use to purchase assets. Yes, granted, it's liquid and it's cheap to borrow money, but the common man isn't borrowing the money. Big businesses are. And so for that reason, I think we need to look at the House and the Congress for those next steps to help us get out of this terrible, terrible scenario.
I brought up Japan earlier because it's important to note that in the 90s, they had accommodative monetary policy, but deflation at the same time. Everyone's talking about inflationary threats from quantitative easing, but some people are forgetting history. And it's important to note that if consumers are anticipating a decline in asset prices, like many who are out of work, for example, they're not going to be purchasing big ticket items right now. They're going to be delaying that. That's going to become a self-fulfilling prophecy. Do you see that risk as being valid in the short term?
Absolutely. And it's not you or I who voiced that first, but Chairman Powell, who voiced the fact that our concern right now is an uptick in inflation. It's exactly the opposite, and it's exactly for the reasons you just spoke about.
Gary, that's excellent. We're gonna follow up on this story with you in the coming week. Thank you very much for joining me today.
My pleasure as always. And traders, have a great week. It should be exciting out there.
Very good. Thank you very much for watching Kitco News. I'm David Lin. Stay tuned for more this week.